Okay. So this week, I'm going to talk a little about Snowflake, disappointed in terms of their outlook going forward, growth at any price, and tying in Cathie Wood's Ark Fund. So let's start with Snowflake. Price $150, almost a $50 billion market cap. Last week, the news dropped and the stock dropped nearly 20% after the company lowered its fiscal 2024 guidance. Now, what does the company do? It's always good to have an idea of what this company does. They are a provider of cloud-based data warehouse solutions. Its services comprise of data warehouse modernization, analytics, data exchange, and engineering, data science, and others. Now, the company has a strong track record of growth, as we can see here. Revenues, since it's been a public company, have surged from 96.7 million in 2019 to 2.25 billion over the last 12 months. That is a remarkable growth rate. And gross profit has also had a massive surge over the same period, from 44.9 million to 1.48 billion over the past 12 months. Cash flows from operations is also increasing, which is a good thing to see there, from a loss in 2019 to 660 million in terms of operating cash flow over the last 12 months. All of these things are good, but price is what you pay for the stock and value is what you get. So what is the value of the stock? Let's look at a couple of ratios currently on Snowflake. Now, its price to sales is 22.8. Its price to operating cash flow right now is 72. Price to GAAP earnings, well, there's no GAAP earnings, so it's negative. There's no trailing GAAP earnings on the stock. Similarly, there is no trailing EBITDA, so its EV to EBITDA is negative. Now, let's compare this to some of its what I'd call quasi-peers. We'll use a price to sales metric here. As like I said, there's no GAAP earnings, and cash flow really is just emerging to better levels. So Snowflake trades at a price to sales in the range right now of 23. Well, this is close to all-time lows for the stock. It is significantly higher than its largest, quasi-competitors in Amazon's AWS and Microsoft's Azure. Multiple of 25 or 23 times sales. Despite the drop in the stock, that 20% drop in the stock. And it just gives the company little room for error. And we saw this play out in real time for the stock when it reported strong growth over this past week, but not to the incredible level of the prior periods, and a slowing growth rate going forward. So the stock then dropped 20%. And again, we'll look at the numbers that the company put out over the past week. Q1 2024 numbers saw revenue up 48%. So that's very strong revenue growth compared to the first quarter of fiscal 2023. That represents, however, a slowdown from fiscal 2023 when revenues grew at 69%. If we see here too, non-GAAP earnings came in at 54 million. That was up from a loss of 2 million in the same period a year ago. That's pointing in the right direction, but stock-based compensation costs still led to a loss on a GAAP basis. And we've talked about Snowflake in the past in terms of its high stock-based compensation. But despite the 48% increase in Q1 earnings, the growth rate declined in revenues. The growth rate declined from 69%. The company guided for the year at 2.6 billion in terms of product revenue. That would be a yearly increase of around 34%. Now, in most cases, 34% growth in terms of revenues is a great number. But when you're trading at the time of the release, nearly 30 times sales, over 80 times operating cash flow, there is no room for error. Now, perhaps Snowflake is the next unicorn, meaning 10 to 20 years from now, we'll look back at Snowflake and we'll say it's had the same sustainable growth levels of, say, Microsoft, Amazon, or the Alphabets of the world. But the trouble with predicting it will be a unicorn is that basically, by definition, there's basically no way to find these unicorns. My main point is constructing a portfolio based on finding the next true disruptor or unicorn and paying any price for it is not good process. Snowflake is a remarkable growth story, but I will not pay any price for a stock. Let me give you an example of a very well publicized fund that has used this strategy over the past 5 years, and let's look at its returns. This is the Ark Innovation Fund, Cathie Wood's flagship fund. Now, if we look at it over the Ark is up 23% year to date during the tech bounce. I guess good on Cathie here, or is it really? If we look in a second, we're going to look at the NASDAQ 100 over the past 5 years. It's surged nearly 28% year to date. So in fact, using this disruptor or growth at any price strategy, the fund has underperformed and in most cases, very significantly underperformed the NASDAQ 100, as we see right here. Even the S&P 500 has outperformed over the long term this fund. So one could just argue that the fund is, and whoever's running it, Cathie Wood, is just not a good stock picker. And I might agree. But it also really points out just the folly of paying any price or any multiple for a given stock, no matter how great you think the business is.
Yeah, well, still 22 times sales. And I recall, I mean, we've brought it up on the podcast before, but like the actual unicorns, Google, or I guess Alphabet, do you remember, Ryan, what the highest price to sales it ever received?
Which ones?
Alphabet or...
I think Amazon got to 40, but that was only during the dot-com boom when it didn't have any earnings. It was 42. So the other companies that you mentioned there, the Microsofts, the Alphabets of the world, basically, never got to the price to sales metrics that these companies particularly did during the pandemic boom, when they got to dizzying levels. But even when you're looking at 25 times, 23 times, which Snowflake is at right now, sales basis, I mean, they just briefly touch those levels if they in fact even get to them. Snowflake has been well above that. And this is, again, at a 15% drop from where it was just a week ago. It's just gotten to the levels where it's trading closer to its all-time low in terms of price to sales. But I mean, that is still a lofty valuation. It's not to say, that's not what we're saying, that this company is a bad business. It looks like a great business. I mean, the growth rate there is tremendous. But are you willing to pay any price for this stock? Well, at 25, 23 times sales, you're paying a high multiple. And if you put in 15 to 25 stocks in your portfolio that have those multiples and are basically have no margin for error, it's not good process in your portfolio from our perspective. And that is why, we shy away from names such as this that have such a high, a low margin for error. Sorry, is what I'm trying to say.
Right. And what was the price to sales ratio 18 months ago when tech valuations were at their peak?
It would be in the hundreds of times.
Sales.
Because the earnings have, or the sales have come up so incredibly. I mean, it was 100 plus times, right? At one point, right? So, I mean, it's great to see it coming down, but I mean, the multiple, the cash flows, operating cash flow, but it's still, it's investing, so it's still spending. There's not a ton
huge
of free
growth
cash
in
flow
earnings, a share price that's come down 65%. And still overvalued, still a premium valuation. So
it tells you how overvalued
it was like 18 months ago in the tech sector.
Yeah. And this is not to say, again, Snowflake is the worst company out there. It's the process of putting a company with this profile in terms of cash flow, earnings, revenue, and the multiples off of that, making bets on 15 to 25 of these companies in your portfolio. For us, isn't good process because you're banking on companies with limited margin for error, and then when they have an error, you can have a 20% decline in the stock in a couple hours, right? So there are companies out there that are growing at good rates, even 30% that you can buy for far more reasonable price. And that's what we're trying to look for. You don't want to buy the cheapest stock out there. And you want the business to be a great business, and perhaps Snowflake is. But to be honest, as an analyst, it's sometimes difficult to know what is the next Amazon, the next Alphabet. But I would rather buy a company at a reasonable price that I think is a very good business. In this case, particularly prior to this announcement, not trading at a reasonable price, at least over the next couple of years.
And it's interesting too, like this is a bit of a segue, but I've been seeing a lot of headlines recently that Cathie Wood missed out on the recent bump that NVIDIA got in its share price, which was about 25%. And the reason she cited the Ark fund actually sold NVIDIA was essentially because she thought that the forward earnings multiple of 50 times on NVIDIA was very high. So I just think it's, kind of
I'm going to say the justification from her there doesn't make any sense when you look at the other holdings in her fund. Like that, That's the thing. If you're going to use it in one case, be consistent across your investment, because we might agree that a stock, NVIDIA, may be trading at a high multiple. Is it justifiable or not? But she's paying hundreds of times cash flow for other significant positions in the portfolio, and then paying for companies with zero cash flow really in the portfolio. So if that is your methodology, stick to it. But if you're going to lean into the disruptor, then lean into the disruptor and continue to own the company if you think it's trading at or it is going to be disruptor and will continue to grow over the long term and the growth rate is high. It seems like picking and choosing there and not sticking to what you think best from my perspective.